Hello and welcome to the investment review for December 2015, which will be the last of this year. It won't be lost on any of our clients with investments that this has been a demanding year. The events of the summer, with markets going into what is reported to be overstated retreat, have seen us having to endure relatively benign investment returns in the last half of the year. Over and above this, however, there have been a significant number of changes in legislation concerning personal finance. To say that this has completely redesigned the way that we as advisors have to consider financial planning would be an understatement. Married with this, a fickle government, and it is easy to see how planning for one's financial future can be cloudy due to a lack of consistency in the financial regime mandated by government. On this slide, let's just take a quick look at what has actually happened over the course of the summer. What I've done here is compared what we would call a typical medium risk portfolio to the FTSE 100. As usual, we've used the FTSE 100 just because it's a chart that is always referred to on the news, etc. And as you can see, our portfolio, because of its mix, is far less volatile, but has been flat during the course of the last half of the year. With regard to some other key events that have taken place this year, we need to give consideration to how proposed changes in legislation could affect buy-to-let landlords. One of the changes that I have alluded to in the opening comments of this review affect buy-to-let landlords. The government are planning to reduce the amount of interest that a buy-to-let landlord can offset against rental income. This can have an extremely damaging effect on the overall efficacy of a buy-to-let portfolio. This website, click on the word website, is pretty straightforward to use, and if you're a higher rate taxpayer and collecting rents and using interest to offset your income, then it can be fairly easy to determine the potential for the impact. This change has yet to reach the statute books, but if it does, any of our clients who fall into the affected category really do need to review this matter closely. Thinking about investment outlook, it is of course never easy to forecast how investment portfolios might perform, particularly in the short term. We have all had to become accustomed to the significant volatility of markets, particularly since the unprecedented events of 2008. Whilst this was 7 years ago now, it has driven into markets new behaviour in difficult times. Turmoil on a worldwide geopolitical basis destabilises markets, and this is notable in the major indices, which can fluctuate quite wildly. The chart on the next slide shows how our portfolios have performed over the last 12 months, and I lay these alongside the MSCI World Index primarily to demonstrate the value of a diversified portfolio. So on the chart we can see the green line, which is reflective of a typical medium risk portfolio. It's notable how much smoother it is, and obviously how much more pleasing the result has been. We can see in the blue line the MSCI World Index, reflective of world markets, that there has been a lot more volatility and a lower result, the same being true of the FTSE 100, which is shown in red. As I said in many previous investment reviews, the most important thing that we can build into a portfolio is balance and diversification. We need to do this mindful of our clients' position in respect of appetite for risk. We also need to understand that our clients have other assets or earnings outside of their investments which can help to support difficult market conditions. What is evident is that interest rates look likely to stay at these remarkably low levels for some time. Given that, it is fair to say that the only way to obtain a return is to invest. Another truth is that a long-term investment invariably outperforms cash, and therefore we encourage our investors not to consider their investments in the short term, particularly during volatile times. Some clients turn to property as an alternative. We regard property as a potentially relevant mix in an overall balanced portfolio. That said, its overall efficacy may be undermined by the forthcoming tax changes mentioned earlier in this review. Aside from this, the next chart shows property returns versus a balanced managed index reflective of a typical portfolio. The investment period here is very long, but the outcome speaks for itself. So you can see that over a long period of time, whilst there is some moderate correlation between these two areas of investment, the balanced stock market investment has returned just under 3 times as much as the Halifax House Price Index. It's always important to add balance and always important to consider another point of view. We do think that markets offer the opportunity for growth, but in order that I can add some balance to this review, in a recent article, click on the words recent article, Barclays have suggested that a fairly significant market upturn is on the horizon. They refer specifically to the emerging markets and the natural resources funds, both of which have been significantly affected in the last 12 to 18 months. It's fair to say that markets broadly correlate, so any recovery here could also be reflected in the more mature markets, for instance our own and Europe. I wanted to have one last shake of the can for our charity effort. By now there is every possibility that you will have felt bombarded by the emails that I sent seeking more help in raising funds for our charity this year. Unashamedly though, here is the link again, click on the link, just in case you can add a few bob. Many thanks to all of our clients who have already so generously helped. So what might 2016 bring? Naturally, we hope that the markets will move forward positively. There does seem to be capacity for that. The changes to financial services and legislation surrounding financial services products means that for many of our clients, we shall be recommending change. During 2016, the vast majority of our clients will receive fresh recommendations based upon the sea change that has occurred in the delivery of financial services in the last 24 months. As a company, we've been waiting for the dust to settle before we step forward with our suggestions. So in closing this review and closing off 2015, I would like to thank all of our clients for continued loyal support. It's not something that we ever underestimate nor take for granted. I would also like to take this opportunity to wish you all the very best for the Christmas season and a happy, healthy and successful 2016. As is usual over Christmas, we will enjoy a short break, but don't worry because during this time all of our email and phone messages will be monitored daily. Our office hours over the Christmas break will be closed from 5 p.m. Wednesday the 23rd of December, reopening 9 a.m. Monday the 4th of January. Thank you for listening. All of our contact details appear on the final slide.